We all understand that there's risk in the world. Put simply, risk is the possibility of loss. And as investors, we tend to focus solely on market risk. But there are many different types of risk. We're talking about longevity risk, inflation risk. There's also sequence of return risk, interest rate risk. There's liquidity risk, market risk, opportunity risk, and tax risk. So let's talk about longevity risk, the risk of running out of money. And that's one of the biggest fears that most retirees have. Now, here are some statistics on life expectancy. So for men, there's about a 1 in 3 chance that you can live to age 90. Now for women, that's going to be higher, about a 45% chance of living to age 90. So you need to plan for a longer retirement. It's saving more. Possibility extending when you start collecting Social Security to get a higher benefit. Maybe it's working more in retirement, or maybe getting a part-time job in retirement. Those are all things that you might want to consider when trying to manage longevity risk. So let's talk about inflation risk. Now, inflation is the increase of costs and goods that we'll experience over our lifetime. And it's one of the areas that gets greatly underestimated when actually planning for retirement. So some of the things that you want to make sure when you're actually planning your cash flow or your expenses in retirement is to really understand how inflation impacts you. If you buy a car every few years and your spending patterns are a little more in consumption, then you're going to feel inflation a little more. Now let's talk a little bit about interest rate risk. Now this is an environment that we're experiencing currently right now, where we're seeing interest rates rise across the board, from short-term to all the way to long-term types of interest rates. And so think about it like fuel in a car. As credit is getting more expensive, so is essentially the cost of fuel. So as the environment and the economy, the overall cost is rising, there's going to be some interest rate risk across the board in some different asset classes. Some things that you will experience some interest rate risk in will be in fixed income, for instance, like bonds. Now, longer-term bonds will have a higher interest rate risk than, say, short-term bonds. But you can also position your portfolio to hopefully participate with rising interest rates by likely going to a shorter duration in your bond portfolio and having some excess cash reserves invested in some of the higher savings rates. We're seeing about a 1% increase in most money markets across the board. So those are some of the things that you want to consider when you're looking at interest rate risk. Now, another type of risk that investors or retirees may feel, and that's liquidity risk. One way you can look at liquidity risk is your own home. We've all seen the values of our homes go up. But when you think about the other side of that, what is it going to cost you to sell that home, to realize that gain? Well, we're looking at a situation where if you have an average home of about $500,000, you're paying 5 to 6% commissions. That's about $30,000 cost to get that equity out. And it's also one of those situations where in times of market turmoil, liquidity and credit tends to tighten up. And so that means that you may be exposed to some assets that have no liquidity or may be very costly to get out of. There's some types of products that have long surrender charges. So you want to make sure you understand what liquidity risk you have in your portfolio, to how to minimize that. Now, you're never going to need access to all of your portfolio all at once. You're usually going to probably have some emergency reserves that will help some liquidity risk, but also you don't want to make sure that all of your assets are tied into certain types of asset classes are generally hard to get to, or be costly, or maybe just time onerous to get access to your principal. Now let's talk a little bit about market risk. Now, some of us are experiencing volatility right now. Volatility is not necessarily a risk in where we're potentially feeling permanent loss. But if you realize those losses and you realize your market risk, sometimes that is a bigger concern. So there are ways to really manage some of that risk, and that's avoiding high concentrated positions in any one asset class or any one stock position or bond, any kind of investment that you have too much concentration in. You're likely to assume more market risk than you need. A diversified portfolio is going to help minimize some of that market risk. Having some bonds in your portfolio that tend to have a low correlation with the stock market, if the market were in some serious decline, will help you with some market risk. Now, that doesn't always move perfectly, but it's going to give you some, I would say, some flexibility if we do have a downturn in the stock market. So market risk is something that is manageable. Diversification is your friend, and you want to make sure you have as many asset classes in your portfolio that don't necessarily correlate with each other to help you mitigate some of that market risk. Now let's talk a little bit about opportunity risk. We may actually take this on unknowingly while we're trying to avoid market risk. And it's a type of risk where we're sitting the market out. Perfect example right now, the market's volatile, so a lot of people are being maybe more conservative than they need to be. And sometimes if you're too conservative or sitting the market out, you're just going to risk losing money safely because inflation is going to eat some of that principal away. Some statistics on that is if you look at over a 27-year period of time, between 1990 all the way to 2017, and that's roughly about 6,800 trading days. If you were out for only the best 15 days over that period of time, which is only 0.2%, you can have about a 39% decrease in your overall assets. So if I invested $1,000 and I stayed invested, I would average right about 9.8% if I invested in the S&P 500. If I missed those 15 days, I averaged 6.1%. Again, that's a 39% drop. So you want to make sure that, again, your portfolio is withstanding a lot of the different types of risk, but you don't want to be too conservative as well because that's also risk in itself. And finally, let's talk about tax risk. Now, most of us will probably lose more to tax than we will in the actual stock market. And it's very important to consider how you're concentrating your assets and accumulation. There's generally 3 pools of money that you can save into. A lot of people will concentrate a lot of their assets in tax-deferred pools like 401ks and IRAs. Now, those are dollars that have never been taxed. And when you pull the money out, whether it's retirement or pre-retirement, you're going to be taxed at some future uncertain tax environment. So you really need to understand that tax diversification is very, very important. That means making sure that you have access to some non-retirement accounts, like a joint account, if maybe you're sharing it with a spouse, or an individual account, or dollars that are invested in a trust brokerage account. There's also the tax-free pool that's very important. You may want to consider maybe if your income drops or you're in a low tax bracket today to possibly look at doing some Roth conversions or realizing some capital gains while you're in the lower tax brackets. Different things to mitigate that. But again, taxes are one of those things we cannot avoid, but we certainly can manage that. And that's one of the things that you need to consider. So by focusing on risk management, in addition to just your returns, will help you sleep better at night and actually help you get a better portfolio and have a better retirement plan in general. Now, if you want more information or if you have some questions on these types of risks, please contact us at Pure Financial.